Imagine you're about to take a road trip across the country. You wouldn't just hop in your car and start driving, right? You'd plan your route, check your car, and make sure you had enough gas to get where you're going. Investing works the same way. If you jump in without a plan, you might end up lost, frustrated, or worse, completely broke. Legendary investor Benjamin Graham once said, "The investor's chief problem, even his worst enemy, is likely to be himself." And he was right. The biggest threat to your financial success isn't the stock market or the economy. It's the mistakes you make along the way. Let's talk about 8 of the most common investing mistakes people make. If you can avoid these, you'll have a much smoother ride on your journey to financial freedom. Buckle up, because this is one road trip you don't want to crash. 1. Not having a clear plan. Imagine setting off on that road trip without a GPS. No maps, no directions, just vibes. How would you know where you're going? The same goes for investing. You need a plan. Be honest. Why are you investing? Is it for retirement, a dream vacation, or just to flex on your friends? Your goal determines your strategy. If your goal is long-term, like retiring at 50, you don't want to take unnecessary risks that could wipe out your savings. But if you're saving for a house in 5 years, you don't want all your money tied up in stocks that could crash right when you need them. Having a clear plan helps you make better decisions, because let's face it, winging it has never been a great investment strategy. 2. Not understanding your risk tolerance. Let's say you love roller coasters. The wilder, the better. Your friend, on the other hand, gets sick just thinking about them. Investing is the same way. Everyone has a different comfort level with risk. Some people can handle the ups and downs of the stock market without breaking a sweat. Others panic at the first sign of trouble. If you invest in risky stocks thinking you can handle it, but then sell everything the moment the market drops, you're not investing, you're gambling. And casinos always win. Instead, figure out how much risk you can actually stomach. That way, you won't panic sell at the worst possible time or miss out on big opportunities because you were too scared to take a chance. 3. Not diversifying your investments. Ever heard the saying, "Don't put all your eggs in one basket"? Well, imagine putting all your road trip money into one gas station's gift card. If that gas station shuts down, you're stranded. The same thing happens when you invest all your money in one stock, one industry, or one type of investment. If it tanks, so does your portfolio. Smart investors spread their money across different investments: stocks, bonds, real estate, even different industries. That way, if one investment struggles, the others can help balance it out. It's like having a backup plan, because the road to wealth is full of potholes. 4. Trying to time the market. Think you can buy low and sell high every time? Even the pros get it wrong. A lot of people try to predict when the market will crash or soar. They sell when things look bad and buy when things look great. But here's the thing. Some of the biggest stock market gains happen right after a downturn. If you pull your money out at the wrong time, you might miss the rebound. Unless you have a time machine, the best strategy is to stay consistent, invest regularly, hold long-term, and trust that history is on your side. Over time, the market has always gone up, despite short-term crashes. So, stop trying to be a fortune teller and start thinking like a marathon runner, steady and patient. 5. Chasing performance. Picture this. You hear about a stock that has skyrocketed 300% in the past year. Everyone's talking about it. You rush to buy in, thinking you'll make a fortune. Then, bam, the stock crashes. This happens all the time. People see a stock doing well and jump in, expecting the good times to keep rolling. But often, by the time you hear about it, it's too late. Remember meme stocks like GameStop? Some people made a fortune, but many jumped in too late and got burned. Instead of chasing the latest hot stock, do your research. Invest in solid companies with strong long-term potential, not just what's trending on social media. 6. Ignoring fees and expenses. Would you pay $10 for a bottle of water when you could get the same thing for $1? Of course not. But many investors don't realize they're doing the same thing with investment fees. Every investment has costs: trading fees, management fees, commissions. And over time, these costs add up. A 1% fee might not sound like much, but over 30 years, it could cost you thousands of dollars in lost returns. Before you invest, check the fees. Sometimes paying a little for expert advice is worth it, but make sure you're getting value for your money. Because just like road trips, investing is way more fun when you're not overpaying for gas. 7. Making emotional decisions. Investing is like riding a roller coaster. There are ups and downs. The worst thing you can do is let fear or excitement control your decisions. When the market crashes, people panic and sell. When it soars, people get greedy and throw more money in. Both are bad ideas. Take a deep breath. Stick to your plan. The market will go up and down, but over the long run, staying the course usually wins. Because investing isn't about making quick money. It's about building real wealth over time. 8. Not staying informed. Imagine owning a car but never checking the oil or tires. Eventually, something's going to go wrong. The same goes for investing. The economy changes. Tax laws change. Companies evolve. If you're not keeping up, you might miss important opportunities or make bad decisions. You don't need to be a stock market expert, but at least check in on your investments a few times a year. Read up on financial news. And if you're unsure, ask a professional for advice. Remember, investing is a journey. There will be bumps along the way, but if you avoid these common mistakes, you'll be well on your way to reaching your financial goal without getting lost. And before you go, if you want to see exactly how smart investors turn $1,000 into real wealth, click here. Your future self will thank you.